Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and today we're going to talk about the yield on cost metric in multifamily real estate investment. This video is going to cover some of the common terminology that gets thrown around. What is the yield on cost? How do you calculate it? And how it compares to some other metrics, such as the cash on cash return, the cap rate, and then finally, how you can benefit from using the yield on cost metric in your multifamily analysis. Just to let you know, this is part one of a two-part video series. Part two is going to be much more involved. We're going to talk about some of the best uses and how yield on cost can be used in varying multifamily business plans, such as development, value add, redevelopment, and we'll actually jump in to some of the pro forma tools that Tactica offers and show you how this looks in real life. Overall, the yield on cost metric is incredibly underrated and serves prominent roles in varying capacities. Let's go ahead and jump in. The yield on cost metric is called many things. You may hear it called the return on cost or the ROC, the development yield, the net yield. I've even noticed that I have different terms for it depending on what kind of project it is. In a new development deal, I tend to call it the return on cost, where if there's an existing property that needs a significant renovation, I'll call it the yield on cost. The definition is it is the stabilized NOI of the property divided by the total cost basis. The total cost basis not only includes the purchase price, but any costs of renovations, deferred capital, or other repairs that you as the investor are going to need to put into the property to make it suitable and make it attractive to your potential residents. Let's go ahead and look at how the yield on cost metric compares to a cap rate calculation and a cash on cash return. You can see we have some general numbers here. The purchase price is 8.4 million. The capex budget is 700,000. The projected net operating income is 545,000. Debt service is 382,000, and cash flow after debt is 162,000. First, let's go ahead and make a cap rate calc. So we have the same numbers as presented before. And to calculate the cap rate, we would just take the net operating income divided by the purchase price. In this case, that's 545,000 divided by 8.4 million. I'm going to go ahead and highlight this just so that's clear. And that would result in a cap rate of about 6.5%. Now let's throw in the cash on cash return. So we have the cap rate calculation we just made off to the left, but the cash on cash return is a little different. What the cash on cash return does is it takes the investor's cash flow after debt service and divides it by the amount of equity they have in the project. To calculate the cash on cash return effectively, there's a few more pieces of the puzzle that we need to consider. That's why I have a debt summary below that highlights the loan terms. So we have a 65% LTV loan. The loan amount is only factoring in the purchase price. So it's taking 65% of this 8.4 million. And in this specific scenario, it's assuming that the investor would have to front the $700,000 in capital repair. This means they would need to bring $3.64 million of equity to the table. I'm going to highlight this because that's going to be the denominator of the cash on cash equation. We have an interest rate of 5.75%, an amortization period of 30 years, and then that annual debt service payment comes out to $382,000, which is represented here. And that leaves us with the cash flow after debt of 162,643. So if we calculate the cash on cash, we would take that 162,000 divided by this 3.64 million. This is a great metric for you and your investors to evaluate what to expect for cash flow during your investment hold. However, it's not as strong of a metric if you're looking to benchmark this property against other comps in the marketplace. Every investor is going to have a different capital stack. They're going to have different leverage levels, different interest rates, different risk thresholds. Maybe they have 12 months or 24 months of interest only payments. Maybe they have no months. Amortization periods can be different. As you can see, the debt payment is very specific to the actual investor. And while it's a great metric for evaluating what your cash flows may look like when you own an asset, it's not as good for benchmarking against other properties that have sold in the marketplace to determine if you're in fact getting a good deal. So that brings us to the yield on cost metric. We have the cap rate calculation, the cash on cash return, and now we'll calculate a yield on cost. So for this, we're going to take the net operating income divided by the purchase price plus capex budgets, which equates to a yield on cost of 6%. So you can see here in this example, the cap rate that's being presented is 6.5%. But really, once you factor in all the capital that will need to be spent to make the property suitable for tenants, that yield on cost drops. And in an ideal situation, the yield on cost metric would be higher than your cap rate. The yield on cost metric is essentially worthless unless you're a market expert. Ideally, you're in contact with brokers, you're seeing their sale comp reports, you're following the business publications and seeing the notice of sales where a cap rate is commonly published. And you're storing this information away and building a bit of a database to help solidify your knowledge and understanding of what the market cap is and wherever you're doing your real estate business. So, as an example here, I'm looking at a handful of sales that have taken place in the Phoenix, Arizona submarket. If we take an average of all these cap rates, it's around a 4.9 cap. I feel comfortable that if I can find a 5 cap deal, that's a market deal. That's not necessarily a great deal, it's not necessarily a bad deal, that's just market. So let's talk about a couple of different scenarios where you could use the yield on cost metric to evaluate if you are truly getting a good deal or not. So let's say you have two deals to pick between. Deal one has a $6 million purchase price and had about 312,000 of NOI in 2022. While deal two, on the other hand, is a little more expensive at 6.5 million and had a slightly higher NOI at about 324,000. So if we do a quick cap rate calculation, but it seems like deal one would be slightly better at this juncture as the going in cap rate is slightly higher by about 20 basis points. But we need a little more information. We learned that deal one needs about $450,000 in capex. It's mostly deferred things. It's like your roofs, your flooring, some landscaping, and there's not a whole lot of NOI upside. The rents are pretty reasonably priced with the comp set, and expenses are about as efficient as they can be. So it's more of an inflationary increase in NOI once we plan to take it over. Deal two, on the other hand, there's a higher capex budget, but a lot of this is cosmetic capital. There's going to be an opportunity to raise rents, and there's some expense ways that we think as we take over as new owners, we'll be able to cut back significantly and raise the NOI with a combination of revenue growth and expense cutting by about 25%. So let's calculate the return on cost. We have a return on cost of 4.99%. I'm going to copy and paste that formula over in column F. The return on cost here is 5.5%. So when we looked at just the cap rates, it seemed like deal one was going to be the better option. But once we factor in the capital expense and the NOI upside, deal two actually appears to be the more suitable investment. The higher the return on cost is above the cap rate, the more potential upside you'd have as an investor. In summary, the yield on cost metric is an incredibly insightful real estate metric and is especially powerful when used in tandem with local market cap rate data. As a reminder, this is part one of a two-part video series, and part two is going to get a lot more granular. We're going to actually dive into the Tactica pro formas and show you how to calculate the yield on cost in a development deal, value add, redevelopment, and really show you how the yield on cost paired with some other key financial metrics can be much more insightful and give you a much better picture on whether a real estate investment is worthwhile and whether or not it should be pursued. Thank you for watching this video. If you're looking for more information on real estate, Excel, financial modeling, underwriting tips, feel free to give the video a like and subscribe. And I really appreciate you tuning in. Talk soon. Thank you.